name is Jason Brooks, Vice President of Wealth Management at Finspire. Investing with an eye on taxes is an ongoing effort. It's important to regularly be on the lookout for opportunities to implement tax mitigation strategies throughout the year. Today we're going to consider 3 strategies that may improve the overall tax efficiency of your portfolios, regardless of the prevailing tax rates today. Strategy number 1, harvesting tax losses. In some cases, you may be able to turn investment losses into a tax benefit. By using losses to offset gains, you may be able to lower your tax bill. For instance, if you have a realized gain in a security of, say, $5,000 and an unrealized loss in another security of $4,000, you can sell that security with the $4,000 loss, reinvest those proceeds into another stock simultaneously, which allows you to still remain invested, but you're actually booking a loss of $4,000. This allows you to reduce your realized gain to $1,000 and thereby reduces your federal tax bill by anywhere from $600 to $950 depending on your marginal tax rate, just from that one trade alone. Now, if you do employ this strategy, one thing to be mindful of is the wash sale rule. Basically what this means is if you do sell a security and want to book a loss, you cannot purchase the same or identical security within 30 days after selling that security at a loss. You also may not sell a security at a loss in a taxable account and then purchase that same security in a tax-deferred account within 30 days of the sale. However, what you can do is purchase a similar investment to the investment that you sold and maintain exposure again in the markets while still being able to book a loss. Strategy 2, managing capital gains. How long you own an investment before selling it at a profit determines your tax liability. Selling an investment owned for less than a year triggers a short-term capital gain, while selling an asset owned for more than a year triggers a long-term capital gain. In general, long-term capital gains receive more favorable tax treatment than short-term gains, which are taxed as ordinary income at your marginal federal tax rate, which can be as high as 37%, whereas the long-term capital gains rate can be anywhere between 15 and 20%. Now let's talk about the third and final tax strategy, which is planning investments strategically. One thing to look at is the tax efficiency of ETFs, or exchange-traded funds, versus mutual funds. Compared with actively traded mutual funds, many ETFs experience lower turnover and therefore fewer taxable events. In addition, the ETF structure is generally more tax-friendly than mutual funds. So when mutual fund investors redeem their shares, the fund has to sell securities to meet the redemptions. Now, those sales may trigger capital gains for the funds and all of its shareholders, even if you as an individual shareholder don't sell anything. But when ETF investors sell shares, they sell those shares to other investors, resulting in no taxable gains for the ETF. So in addition to using tax-efficient investments to create a solid foundation in the portfolio, there are some other tactics, if implemented correctly, that could help limit the annual tax bill as well. One of these strategies is to pursue just a buy and hold strategy, which would reduce turnover in general in your portfolio. The other common technique would be to hold less tax-friendly investments in a retirement account versus holding them in a taxable account. This means that any investments such as bonds that generate ordinary income, like interest income, should be held in retirement accounts where you don't pay taxes until you withdraw funds. Also, high turnover mutual funds or alternative funds are best held in retirement accounts. For taxable accounts, where you do pay taxes on the earnings, municipal bonds are always the best type of bond to hold because their income is tax-free. And when it comes to mutual funds, best to hold either low turnover mutual funds or ETFs. And then also just avoid taking short-term capital gains if you can in general, which again are taxed at a higher tax rate. And the best way to do this is just hold investments for more than 12 months before you sell them. That will allow you to get that more favorable long-term capital gains tax rate. So thanks for listening today, and expect more videos with various tax and investment tips to come in the future. Take care.